Welcome back. Well, we do have the first management, or rather the second management on the show. We have Akums Drugs and Pharma, Sandeep Jain, and the CFO Sumit Sood, who are with us to discuss the numbers gone by. Remember that they've delivered their Q1 FY25 numbers for the first time since listing, and revenue growth was up around 5% this quarter. But what stood out was the operational improvement that they reported this time round. So, Mr. Jain, let's start with you. It's an operational improvement this time round in terms of the margins. It's come in at around 12.6%. It's an EBITDA gain versus a loss on a year-on-year basis. Tell us what led to this particular improvement and what are we expecting in the next 3 quarters in terms of margins? Mr. Jain.
Yeah, it is only because of the we are always taking care of the efforts which has to be made. Like 400 scientists are working day and night for developing so many products, and we always make sure that a few of the new products should be marketed and offered to the market quarter on quarter basis. That is the first. And one was one that Mr. Sumit will be in a position to let you know about this put option. But the most important part is always new products, new technology, and service to the clients. That is the most important part, which we make sure that it should be always there with the clients.
Okay, all right. Well, Mr. Sood, if you could just elaborate a little bit. And, Mr. Jain mentioned the put option. Just wanted to understand if you could give us more details about that. And it is eventually expected to improve your margins going forward as well. So just give us a sense in terms of where things stand with regards to that and what your guidance on operations would be on the operational margins.
The way the put liability works is that we had an investment agreement with our investor Quadria, which there was a condition of a buyback of their shares. So this, as per the accounting standard, is a notional entry which gets into the books of accounts, which is done based on the cash flows. So this, till the date that we have reported, which is June of 24, cumulatively had an impact of 1,361 crores on the net worth. So what happened was, like you're showing a huge improvement there, while the company had constantly been in profit and the cash flows were positive. But because of that notional entry, the financial results that came out in our balance sheet did not show the correct, profitability of the company. So that on 29th of May, with the shareholder agreement, was removed. So this period, you see an EBITDA of 130 crores. That's the adjusted EBITDA, compared to an adjusted EBITDA of 108 crores over last year. So that's really how it is. And, our PAT margins are at 58 crores. They were close to, 37 crores in the previous period. That was the adjusted PAT. So I think that's really how the company has been performing. And as the MD said, that we would continue to focus on new products and our developments to see that we meet our expectations going forward.
Okay, all right. Hi, Mr. Jain and Mr. Sood. Thanks a lot for joining in. This is Nigel on this side. Let's get a couple of numbers out of the way. The CDMO business, out there you had margin improvement, which was quite substantial. It's moving towards the mid-teens, the EBIT margins. What's the outlook on this part of the business? And on the smaller part of the business, which is the API business, when does that turn back into the black?
Sandeep, so let me first take you through the financial numbers. Like the CDMO business has been doing a 15% margin year on year, and we see that trajectory to continue for us, right? The API business, which we acquired in 21 through an acquisition of Parabolic Drugs, we've been drastically, the whole year of operations, we sort of made 103 odd crore EBITDA loss, which came down to 43 crores last year. We see that our EBITDA margin for this quarter, which is a negative 17%, which was negative 23% over the last period. Now we've put in all efforts to ensure that this business slowly comes to the black, but to really give a time frame to see where it will turn in green or black is slightly difficult to say right now. But our endeavor is to see that we bring it back to the way our other businesses are.
Okay. Mr. Jain, just give us a sense in terms of the FY25 growth then. What are you expecting as a whole in the CDMO business? In terms of demand that you're seeing, incremental clients that you would probably be servicing in the next 3 quarters?
See, we are growing 15% on a CAGR basis year on year, and we are making sure that the production, the quality, the systems should be remain same, and we hopefully we will be able to maintain the same pace in the 25 as well.
Okay. The other question that I had is on your branded formulation segment. Your margins improved quite drastically there, Mr. Sood, this time round. Tell us what led to this improvement and what are the margins that we're working for in the branded formulation segment? Is this 10% now sustainable?
So, this business was broken down into 3 parts, right? We had the export business, we had the brand marketing, and we had the trade generic. Now, what we've consciously done is we looked at restructuring the business in a manner that we have these sustainable margins. So we've sort of focused on our exports and the brand marketing, and we've sort of scaled down our trade generic business so that we think these margins going forward between 8 to 10% would be sustainable.
Okay. All right, Mr. Sood as well as Mr. Jain, we're going to leave it on that note. Thanks very much for joining in and speaking with us and giving us all of that perspective. That's Akums Drugs. The stock is down around 3.5%. Revenue growth was subdued, but the margins did see an improvement, an operational improvement this time round. Well, we need to take a short break, but we'll get you more on the markets once we're back. Stay tuned.